And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Agbiz CIB. Discover the latest trends shaping digital assets across Africa. Download the Agbiz Africa Digital Assets Insights 2025. Good evening, 8 minutes after 6. Welcome to the program. I'm Stephen Grootes. I was reading Fin24 today and Carol Paton's piece about the huge amount of money we're putting into infrastructure, government's putting into the national grid. And we all know this is the sort of next big problem. We seem to have solved generation for now. No load shedding, but the national grid is the next big problem. To do that, you do need international help. I don't think there's any doubt. You need people with lots of expertise, people who've done it before. And we'll hear from Carol in a few moments. We'll hear from one of the other role players in this, but it does appear that essentially people who are working in this field will not necessarily need to have experience if they're the BEE partner. In other words, anyone who qualifies to be a BEE partner could actually be one of the partners for these international firms with no experience in the field. And Kashif Wicomb is the CEO of one company that you would think would actually be one of the obvious partners because they do have experience. We'll hear his view in just a moment. He's as I say, the CEO of one of these companies, but he's also the president of the Progressive Professionals Forum. So very interesting. A lot more confidence, it seems, flying around. And there's been suggestions that some of the good news we've seen at the very top level of the economy may be filtering down. Well, a new confidence survey coming out from the Bureau of Economic Research in FNB. Siphamandla Mkhwanazi is the senior economist at FNB, will be on your radio in about 10 minutes from now. We'll also talk about policy uncertainty. So the Policy Uncertainty Index, that comes from Northwest University's Business School, that's down. Down is a good thing when it comes to policy uncertainty. So looking forward to that conversation. Professor Raymond Parsons there. And I have to tell you, I was slightly outraged when I saw the news for the first time that Botswana has reinstated its ban on South African vegetables. I mean, it was finally sort of culled earlier. It was earlier in the year, late last year, but now it's back. Makes no sense to me. Try and get an understanding of what our vegetables do to Botswana farmers, but still a very strange story. We'll speak to Wandile Sihlobo about that in a little while as well. Don't forget Warren Ingram later, and we'll also speak to Ayabonga Kawe later as well. He's been looking at the issue, and as you know, he's at the International Trade Administration Commission. He's the chief commissioner there, but he's been looking at the issue of intervention in steel markets, and it does seem to be something that's happening around the world. I don't know. How would you respond to Botswana? I suppose would have to be my question. You keep banning the sale of the importation of vegetables, and you do kind of mean our vegetables. So what do we do? Do we ignore them? Do we sort of knock on their door and say, "Oi, why are you doing it?" I do think it would be good neighborliness to tell us in advance, in a month's time we're going to do this, and I don't get the feeling that they did. But your thoughts, how do we respond to Botswana? 011 8830 702 021 4460567 in your voice notes, please. On 072 702 1702.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, an important piece in Fin24 today by Carol Paton explaining how the 400 billion rand investment program to build the national grid or electricity transmission lines will see international firms pairing up with BEE partners. The BEE partners will not need to have any technical expertise. In other words, an international company can be part of a contract to build our electricity network using a BEE partner that is not currently involved in electricity at all. And it would seem that government has refused so far to use the situation to build the capacity to build the lines ourselves. To put it another way, instead of using BEE companies that exist with experience and then using this to give those companies that capacity, then that capacity would remain in the country afterwards. Government is doing this in a completely different way. Well, we'll hear from Carol Paton herself in just a moment. But first, let's hear from one of the firms that is 51% black-owned and has experience in this sector, in a company that maybe would be sort of near the front of the queue to be part of this. It's called Adenco Construction. Its CEO is Kashif Wicomb. As it happens, he's also the chair of the Progressive Professionals Forum, a body which primarily supports the policies of the ANC. Kashif, good evening. So, I presume you were expecting to benefit from this build program. You have experience. You'd be in the prime position to work with an international company because of that. Now they don't need a company with experience. Where does that leave you?
Good evening, Stephen, and thank you for having us. Look, I always like to speak on behalf of the country at large as opposed to on behalf of my own personal self-interest or narrow interests. The ITP program provided a perfect opportunity, or provides a perfect opportunity for the state in what is probably one of the largest procurement exercises in a while to push forward the strategy and objective of localization, combating unemployment, and getting South African companies, South African-owned companies internationally ready. And so we believe that with the RFQ, the request for qualification, such an opportunity was lost. And we are hoping that this will be rectified in bid window 2, or even closer in the request for proposal, or in the shortlist, which will be published, they say, on the 10th of December, sometime this week.
Okay, so let's put it another way. I appreciate you don't want to talk in very particular terms or specific terms, but if there's a company like yours, there are others like yours, that would be paired with an international company, and then they would be involved in this build program, would be their partner, what kind of opportunity would that be for a company like that?
It will be huge, because you must understand, Stephen, that local South African companies, and when we say local, we speak about contractors, consulting engineers, manufacturers of equipment, they would be almost at the top of the pile in terms of which they would have been the developer, owner of these transmission assets for the first time in their trade history. And of course, they would be able to keep the sausage machine alive as a contractor, design engineer, or manufacturer, but also ultimately being a co-owner with an international operator of a transmission asset, similar to what large contractors did when the toll roads were published, plus minus, in fact, it's 25 years ago. Local South African contractors partnered with international operators with experience to manage toll roads for a 20-year period in the using the public-private partnership model, similar to what the ITP is envisaging.
Okay, so, I mean, to put it another way, it would create a huge amount of capacity in South African-owned firms. And who knows what that capacity could be used for? It could even be used to, build another, to upgrade the grid in one of our neighbors, for example. I mean, it could be the start of something.
Definitely. And Stephen, if one thinks beyond South African needs and requirements, and you just lift your head and think 20 years from today or 15 years from today, this opportunity could give rise to a South African company, EPC, design engineer, or manufacturer, to become an international operator and go to another country and provide that international experience in another country, similar to what the Chinese, the Spanish, the Asians, the Turks, the Brits, the French are wanting to do in this round. So there is a massive opportunity that could be lost if the procurement process is not firm on transformation and black economic empowerment. And I must add, Stephen, probably for the first time in our country's 30-year history, the transformation agenda of the state is to the benefit of SA Inc., South African Incorporated, which means both majority black-owned and white-owned companies, but it is to the benefit of the country at large. Because you can't push for local content, you can't push for using local South African companies and so. But by the way, I'm not promoting transformation and black economic empowerment.
Kashif Wicomb, thank you very much indeed. CEO of Adenco Electrical Construction, also president of the Progressive Professionals Forum. Well, Carol Paton is the person who wrote this, a writer at large at News24. Carol, good evening. I mean, from what you say, it would seem we're missing quite a big opportunity.
Good evening, Stephen. Yes, I think Kashif Wicomb really put it well. It is exactly that. These are black empowered companies that are homegrown South African companies that built themselves up. Here's the opportunity for them to go the extra step, to take the next step up, and to become global players on the continent, because we always talk about how South Africa should be a global player on the continent, and that's what we want to see. And here's an opportunity to build that capacity, and it's not being taken up. And, it really just requires a very small change, because nobody is saying, this is not a debate about, we don't want white firms to get more business. This is a debate about, we've got fully empowered black-owned companies that are fully competent, that are building power lines, that are building substations. They've been doing it, some of them for 100 years, actually, in their former iterations, before they were sort of majority black owned, and they're not going to get this opportunity, because politically the opportunity should go to BEE holding companies. Now, the thing I think that you didn't explain and Kashif didn't explain is that these global players, so the requirement is they do need to have an empowerment partner, but the empowerment partner doesn't need any expertise. So for them, it's preferable to say, oh, well, it's going to save me a whole lot of hassle if I don't have to do any negotiating about the contracting, the supplying, the equipment, and I'll just go in with a BEE holding company or finance company, and they'll just take 49% shareholding, and they won't bother me for the duration of the project.
Why do you think government is going this route? I mean, I've been scratching my head. You know the area much better than I do. Could it be simpler for international companies? Could that be the benefit? Could there be something else? And I'm afraid, Carol, as you know, we live in a cynical time, and all I could think of was cynical explanations.
No, look, it is actually the only reason to prefer this option, which is, international firm plus black-owned entity with no experience versus international company plus black-owned entity with experience. The only reason to do that is for rent-seeking purposes. There's no other reason to do that.
Yeah, it would seem that that's the only way to do this. Carol Paton, thank you very much indeed. Writer at large at News24. The only way to understand it is what I meant to say, because it does seem like that. I think probably after listening to that and after listening to our guests, we do owe the electricity minister or the ministry, whichever, a right of reply. We will make some calls tomorrow morning or later tonight perhaps and see if they are available. I don't know if the minister himself might prefer to respond or if someone from the ministry. But I think there's a lot to look at here. Your thoughts on this? 072 702 1702.
702. Stephen is on X.
At Stephen Grootes.
Well, confirmation today that as a consumer, you're feeling a little more confident than you were a few months ago. But you're still feeling less confident than over the longer-term average. The F&B Bureau for Economic Research Consumer Confidence Index being recorded at -9 in this quarter, an improvement from the figure of -13 in the quarter before. That would be the third quarter. Sipamandla Mkwanazi is the senior economist at F&B. Sipamandla, good evening. We're still not very confident, but why are we feeling more confident than we were?
Thank you, Stephen. Good evening to your listeners. Yes, we are still below that -1 average since 1994. There were a number of developments, positive developments, that contributed to this relatively positive outcome. The first is that we are in an environment where inflation is stable, food inflation has come down a little bit, from the time of the previous survey to this current survey. We've seen fuel prices going down by about 43 cents. If we look at food prices as well, inflation peaked at around 5.5% from the previous survey to around 3.9 now. We've also seen interest rates coming down. So there are all of these positive developments, and especially for the high-income households, middle-income households, the rent has firmed since the last time. So affordability overall has improved quite a bit, and you do see that in how consumers are engaging at the shopping centers.
So from what you're saying, the richer you are, the more confident you're feeling. I imagine we see different feelings of confidence in different parts of the economy.
You would think so, Stephen, which is confusing for me at least out of this outcome, because a lot of what I've counted for, a positive budget, South Africa being upgraded by S&P, South Africa being removed from the grey list, that is the stuff that more of your high-income households tend to care more about. But what we saw in the outcome was that, in fact, their sentiment actually went in the opposite direction. Their sentiment is at -12 from -11 in the previous quarter, which is quite difficult for me to understand why that would be the case. But also context is important here. The survey was conducted between the 10th and the 21st of November. So I presume the latest interest rate cut, which was on the 20th of the month of November, would not have made that much of an impact here.
As you say, interest rates are clearly a part of this. Inflation's clearly a part of this, a general feeling. Is politics a big part of this? I suppose, to put it another way, is consumer confidence tied somehow inextricably to the national coalition?
Yes. No, that is one possible factor, Stephen. It has been quite volatile this year, not just from a domestic political landscape perspective alone, but also from a global perspective. In fact, if you look at the confidence of your high-income households, those again who generally care about such stuff, they were much more pessimistic at the beginning of the year. Now, that is the time when there was this a heightened uncertainty around global politics. Now, it has improved over time, but I would have expected that, given the relative stability we have enjoyed in the last couple of months, that it would have supported their sentiment. It wasn't to be the case. Possibly that would be one of the biggest drivers.
Things in South Africa are mainly things we can control, but things outside South Africa are things we can't control. I think you know who I'm talking about, Sipamandla. How big a factor is that? I'm talking specifically about the US.
And absolutely. That's possibly one of the biggest factors, particularly for those high-income households. But out of that, Stephen, there also is a blessing in the sense that, with the spat between the US and China, the Chinese have had to find alternative markets. So they are exporting deflation. We are seeing, bigger and bigger consignments of your household contents, your furniture, your electronics, and they are coming at a much more lower price as well. So we're getting all of these goods at a cheaper price. The rand is stronger. Overall affordability is improving. Those developments tend to support sentiment. We do hope that we will see much more of that in the next quarter.
I mean, it's fascinating because new car inflation, I think I saw, was at 1.6% at the moment, which means that suddenly there are many people who may now be able to buy a new car for the first time in their lives. I've never bought a new car now that I think about it, but you can buy a new car which you considered unaffordable before, simply because of how the car industry has changed so dramatically.
100%, and it's evident in the volume of new cars that are shooting out the light at the moment. So you take that cheaper level price, you take lower borrowing costs, and you also take the changes in the funding models. Now we can have a debate about whether this is a correct model or not, but it is getting cheaper and cheaper to own a car, and we are seeing consumers taking bigger balloons, even on cheaper cars, even those that are coming from the East. So it is getting cheaper and cheaper. Hence, we are seeing this level of volumes of new cars.
Buy now, cry later. If there's a big balloon. Sipamandla, thanks very much. Sipamandla Mkwanazi is senior economist at F&B. 26 minutes after 6.
The Money Show.
The Markets.
Ryan Hill is the head of fundamental sales at Agbiz CRB. Ryan, good evening. Good to talk again. Tungela are up 4% today. They seem to get higher coal volumes going through, but a bit of a warning about the future.
Yeah, evening, Stephen, and good to be here. Definitely the numbers were well seen, perceived by the market. You had South African production pretty much ahead of guidance. Australia seemed as though it came within expectations, so looking good operationally. But they've got some, of course, tailwinds on the pricing side. Thermal coals now basically run up to the sort of low $90, but they do have a bit of a headwind in the form of the ZAR at the moment. Having said that, it does sound as though they're continuing to benefit from Transnet's improved performance. So it looks as though we might see some better volume coming through over time.
By my amateur count, I think Thungela are the first South African company to complain about a stronger rand. They may not actually be the last if you look at the way things are going.
Well, indeed. Look, I mean, it's ultimately going to be a function of what happens to the dollar. So it'll be interesting to see how the mix of currency and commodity prices play out overall for the commodities complex. Of course, a weaker dollar means a stronger rand, but it also means a higher commodity prices. So at the end of the day, it's really going to be about that mix and how that plays out.
SPAR down 3% on the day. We spoke to their CEO yesterday. They've got rid of a lot of their debt. They've sorted out their issues in Poland and Switzerland finally. I mean, their future seemed to me, their outlook seemed to be a little more optimistic than perhaps their last 2 years have been.
Yeah, look, I mean, so when the numbers came out yesterday, I think the one thing was clear is that the group EBIT continues to remain under a bit of pressure. Those numbers were down about 6%. And frankly, we found it quite challenging going through the numbers to sort of split out the performance very clearly between the first half and the second half. And that's largely because there were quite a couple of restatements going through the accounts. It is fairly clear that they also had a very strong Black Friday. Now, of course, one could argue that that's probably a function of aggressive discounting, which is what we heard through the grapevine. But I think the market's being a bit discouraged here by the shifting guidance with respect to their margins. So they're looking for a 3% margin. I think the initial target was 2026. They're now talking about 2028. And to put that in context, they're currently sitting at about 1.8%. So I think the market basically just, marking down expectations here.
SAPI down 6%. What's happening there? And I realize they're in a very complex position.
Yeah, so you saw the deal announcement a couple of days ago, I think it was the 4th of December, around combining their European graphic paper business with one of their competitors, UPM Kameni. Look, I mean, we didn't think the deal was particularly positive. It was really just shifting around furniture on a sinking ship. But the graphic paper market's been very, very difficult. In fact, prices continue to decline there. And to be frank, I don't think we're going to see any bounce as far as dissolving wood pulp pricing is concerned until we have some resolution of the US-China tariff situation. So, yeah, for now, I think the market's probably going to continue putting pressure on SAPI, just given how difficult those fundamentals look.
I mean, in a way, this is all about the long-term future of that company, and they have so many different things to manage.
I know, and there's still excess capacity. There's a weak European demand environment. Management have their work cut out for them.
Ryan Hill, thank you so much. Really do appreciate it. The head of fundamental sales at Absa CIB.
WhatsApp Stephen
on 072
702
1702.
24 minutes now to 7 the time. Well, you heard that conversation earlier around the BBBEE issues around the new Department of Electricity's policies towards building the new grid, essentially upgrading the grid that we have. A huge amount of money being spent on that. And the sort of, as you heard in the conversation, news that, in fact, the BEE partners, these are the companies that will be pairing up the big international companies that will be doing a lot of the work, don't need any technical expertise, don't need to be working in electricity now. It's a strange thing because it does seem like an opportunity lost, certainly from what we heard tonight. Just to update you, we have already sent messages to the people at the electricity department. I'm hoping that the ministry or maybe the minister will be available to talk to you tomorrow on this. I do think it's an important story. I saw today a fascinating story about steers and debonaires. And they've now launched the first steers and debonaires combo in Malaysia. And it does make you think about where South African fast food ends up. And we can complain about the McDonald's and the Burger Kings and all the other things that you get here. But think about it like this. If you go to many parts of the Middle East, you will find Spur, you'll find Nando's, and it is quite something that actually in many parts of the world you do find South African fast food brands. And I say that because it is so competitive. There are so many different types of fast food around the world, and yet our brands seem to be doing really rather well. Nando's has sort of taken over the world. People in Britain, I find this hilarious, think it's British. They also think they're good at rugby, but they seem to think that that Nando's is a British thing. I mean, obviously it's not. It's from Bez Valley. How do we know? We were there. Anyway, if you were overseas if you were in a different part of the world, let's say, maybe you're in Lagos or you're in Beijing, which South African fast food brand would suddenly make you feel a little more cheerful? 072 702 1702.
The Money Show.
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
And DSTV channel 856.
18 minutes to 7 the time. Well, good to hear from you tonight. 011-883-0702 and 021-446-0567. Voice notes too. Which South African fast food restaurant would you be the happiest to see if you were in another country? 072-702-1702. You heard the conversation around consumer confidence a little while ago. Well, also today, I suppose coincidentally, news from the Northwest University's Business School's Policy Uncertainty Index. That's looking better too. It's gone from a record high of 81 points in the third quarter to just under 65 now. Just to be clear, when we talk about policy uncertainty, lower is better. Professor Raymond Parsons is the economist at the NWU Business School. Raymond, good evening. Thank you for your time. What is pushing your policy uncertainty index down? Which factors?
Well, good evening to you. Look, I think in the last few months, compared with the first half of the year, we've seen a convergence of a number of good news items, which I think some of us will be familiar with, such as a good medium-term budget policy statement, well received by the markets, the fact that we got off the grey list, the fact that that one of the major rating agencies has upgraded our status. I think it was the accumulation and the convergence of this better news that has enabled us to reflect it in this index. This is now saying that as we move into next year, there is less uncertainty, there's more of a platform on which to build a better economic performance next year. So I would say that in a sense, what the index is now saying and what some of the other indices are saying as well is that the table has been laid for next year. And now we've just got to ensure that we can serve a good growth, job-rich meal.
The thing that sort of struck me over the last month or so with the issues around the good news you talk about, a lower inflation target, lower government debt, clearly a determination, it seems, from government to pay back that debt and lower debt. All of those things together, plus the fact, and we shouldn't forget this, that that difficulty over the budget, the political fight over the budget at the beginning of the year seems to have completely disappeared. Everyone seems to be on the same hymn sheet now. It would seem to me that government, the national coalition, has some direction. And once you see a government moving in some direction, you immediately reduce policy uncertainty.
Well, that's right. And the reverse of that coin is that it also builds confidence that more of the right decisions will be taken next year about the economy and that they will be implemented. I would just say, though, that a lot of the progress that we've made this year, and which is reflected in the various indices, is on the financial front. Inflation, interest rates, what the rating agencies think of us, getting our deficits under control. What we've got to now also understand that next year, the focus has to be equally on the real economy, because the things you and I talk about may sometimes seem very remote to the average listener. What we've got to say is, as we move into the next year, we've got to use this better financial news, in particular, to up our growth rate, to get more fixed investment, and to get lower unemployment. That's the real economy. So we've got to use some of the better news on the financial front and ensure that next year we take those decisions that will make a difference on the ground in terms of higher economic growth, more fixed investment, not the markets, the JSE or the financial markets, and above all, begin to show further progress, as we've done in the past few months, in beginning to bring down the high unacceptable level of unemployment. So we are in a better position now to be able to address those issues, and the ball is in our court to show that we will seize the moment next year to do it.
How big an issue is crime? And I say that from a number of perspectives. The one is just, I think in many places, if you want to expand your business, you're just worried that actually you might not be able to keep the assets you want to buy, particularly, and this is really a construction question as well, because crime and construction mafia has been such a big issue there, although there seems to be some progress on that. And then I watch, I'm sure as you do, with my jaw on the floor at the revelations at the Madlanga Commission, the Parliamentary Commission, and you wonder if we're ever going to get on top of all of this. How big a factor is crime, do you think, in the fact that companies don't really want to invest in expanding production?
I think this feeds right into my point about the real economy, that we can talk about inflation targeting, about deficits, but on the ground and in people's lives, the issue of crime is a real factor affecting the real economy. So quite clearly, apart from the progress that we've made so far and building a positive platform in which to go into next year, we've got to show that among the other indices we're going to get right is to reduce the level of crime in South Africa and change the optics on that side of the equation. But we've had to get some other things right first in order to get the markets and investors in the right frame of mind. We have got them in the right frame of mind, especially after the G20 and having had a very successful hosting of that. But now, as I've said, we've got to show that in the new year, we're going to translate this cautious optimism into real change, particularly on issues such as crime, so that we can consolidate the better news that we've experienced up until the end of this year.
There really does seem to be a very strong link, and it's an obvious link between politics and policy uncertainty. And it seems to me that towards the end of next year, so probably 10 months from now, we will be talking quite divisive politics because we'll be going into a local government election. There'll be a big fuss about the result of that. January 2027, the conversation immediately will be who will take over from Cyril Ramaphosa as leader of the ANC and presumably at some point as president of the country. Do those things worry you?
I think it's important from an investor point of view, and that's what we're really talking about. We want next year to show progress on the fixed investment front. We want more investors to commit themselves to the long term. What do they want? They're not really into party politics. What they're saying is, we want to see political stability and we want to see policy certainty. And I think if our politicians and our political leaders, whatever they're infighting, can nonetheless bear in mind that there can be collateral damage to both our political stability and our policy certainty if they don't play the game according to certain rules, then we will not get the economic performance we want. But I think the important point is, if you want to get the good economics, you've also got to get the good politics, and that is a challenge to our political leadership of all political parties, whether inside the GNU or outside the GNU.
Professor Raymond Parsons, thank you so much. Really do appreciate it. The economist at Northwest University's Business School and, of course, the prime mover behind the Policy Uncertainty Index. 10 minutes now to 7.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
8 minutes to 7. Well, I was talking earlier about debonaires and steers, the first steers and debonaires combo opening in Malaysia. If you're out of the country, which is the South African fast food restaurant you'd want to see?
Hi, Stephen, Jenny G. Just for the record, Nando's comes from Rosettenville. My husband actually taught one of the Nando children. I can't remember which one it was, but yeah, from Rosettenville, a worldwide success story. For me, it would be Simply Asia, which would be quite strange, hey, if we're already in Asia to have Simply Asia. But I go there every Friday and I love their food. It's so fresh and perhaps not too vreemd, to put it that way. Cheers, bye.
Lovely word, vreemd. Thank you. I don't think I've heard it on this radio show before. Thank you for the correction about Rosettenville. If you're from Bez Valley and you would like to respond to Rosettenville and reclaim the birthplace of Nando's, feel free. 072 702 1702.
702.
702.
Stephen is on X.
At Stephen Grootes.
And while we'll let them fight it out, we should probably talk about something that's getting a little more complicated. You may remember Botswana's ban on some of our vegetables, and they finally lifted it. Well, I don't know how to feel when I tell you that it's been reinstated. And for the moment, if you are traveling to Botswana and you happen to, I don't know, have some tomatoes or something in your salad or potatoes or many other vegetable products, in fact, you could be in big trouble. Wandile Sihlobo is the chief economist at the Agricultural Business Chamber. Wandile, good evening. I remember, I think you and I shared a similar frustration. I think you might have been a bit more frustrated than I was when this was imposed the last time. I would imagine you're feeling a bit frustrated again tonight.
It's frustrating more tonight, Stephen. Not only just because it's a disruption on business activity, but also the fact that within the SACU, we seem not to be following the rules of what really is going on. And I think that if each and every country, whenever they are unhappy or they have certain aspirations, they wake up and then they place a ban and they don't communicate with the next country, but also communicate in press releases, that causes a lot of disruption. I would that there will be better coordination, us in South Africa understanding the aspirations of what Botswana attempts to do, and then making sure that we support them in those efforts, other than the current practice that we see continue.
Do we know what impact our vegetables have on Botswana's farmers? Are we preventing them from growing? Botswana surely has strong commercial farmers.
They do have strong commercial, but more on the livestock. And Stephen, they are not even a big way of. Let me give you these few numbers. South Africa exports about $218 million worth of vegetable products to the world market, and Botswana is about 8% of that. That must be $17 million or so. But of course, it's not like we are making Botswana drown on this. And someone on X said, causes a storm over tomatoes. The issue is not tomatoes. The issue are the rules that are not being followed in SACU. And while SACU also, in a way, presents a lot of challenges for South Africa, want to do bilateral trade agreements with countries. We are having to come back to consult countries that do not consult South Africa. So for our economic diplomacy thinking, we are now running into a lot of friction here, which is why I always argue that SACU needs to be reviewed, both for easing our trade agreement, but also for easing up the friction that we currently see, so that the South African businesses can plan well on what to do in this.
Wandile, we are losing you a little bit on that line. I don't know if you're able to strengthen it. But this is the one thing I just don't get. If I were Botswana, South Africa's a much bigger economy than yours, surely you just tap us on the shoulder and say, look, I'm battling with this, I'm going to do this. From what I can see, there was no notice at all. Or no, even better, look, can we get together and have a coffee? I'm paying.
Absolutely, Stephen, because the core thing is that you can tap on South African shoulders and say, I am trying to grow my XYZ industry. And in a way, we can even assist on making sure that you have the inputs to do that. Thereafter, the South African industries will be able to plan appropriately as to what to do under these dynamics. The challenge is the inconsistency when rules change importantly, the fact that when South Africa now has to negotiate trade agreements with any other country in the world market, we cannot do that unilaterally. We have to come back and talk to SACU and follow the rules. And we've been doing that. But the challenge I'm having is that SACU members do not follow the rules of SACU. What is constrained in a current environment where we are trying to push export diversification, and we cannot move at our own pace without considering neighbors that are unconsiderate.
Wandile Sihlobo, thanks very much indeed. A lot more to ask, just that line giving up on us. The chief economist at the Agricultural Business Chamber. I have to say, I just I literally am scratching my head. Because surely that's the thing you do, is you sort of say, can we talk about this? Can we have a negotiation about this? But as Wandile says, the sort of unilateral nature of it, the fact that it just happens, the fact that, there's no discussion. And then this time it seems to be quite a wide range of vegetables. And from what I understand, I haven't done it myself, but actually taking stuff through Botswana, very difficult to do. You also, you're punishing someone for carrying tomatoes. It just seems a little bit bizarre. Sure, if it's a bucket of tomatoes, well then obviously someone's trying to break the law. But I do just think that surely we can be a little better about this. What it also tells me, though, and we mustn't fail to recognize this, is it would seem to me that the Botswana government, first time they have a new political party in power, never happened in their history. Politics in Botswana is becoming more accountable, a bit like ours in so many ways. And what you're actually seeing is that the government is clearly responding to a very organized, a very important constituency. And that's a big part of this. It's a bit like, how do we make sure that actually the US doesn't impose steep tariffs on our wine or oranges, for example? To really do it, you have to go deep into American politics. You have to go into whoever the constituency is, farmers or whatever, and say to them, get your government to change. And Botswana, maybe we need to do the same thing. We need to go and find the constituency and say to them, and it might well be consumers in Botswana, because I presume that there are fewer vegetables around. That pushes up their pricing. And so we need to go to them somehow and make the claim there. You need to apply domestic political pressure on the Botswanan government. That's really how you would do it. All right, coming up, we'll speak to someone we've spoken to a couple of times. He's someone who has a very important position. Ayabonga Xawe is the Chief Commissioner at the International Trade Administration Commission. We'll speak to him about steel industries around the world and how governments are intervening. Rotendo Ndingwi will be with you, and of course Warren Ingram as well. You're with The Money Show. Good evening at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Agbiz CIB. Discover the latest trends shaping digital assets across Africa. Download the Agbiz Africa Digital Assets Insights 2025. 6 minutes after 7, the time. Rotendo Ndingwi already here. He, of course, is the founding director of Tribe Africa Advisory. We'll look to an extent in that conversation around Chinese exports to Africa. We've been talking about the car industry already tonight, what that does for consumer confidence, because new cars are cheaper. The world is changing very quickly when it comes to trade, and it's absolutely fascinating. I find it really interesting. So we'll talk about that. Ayabonga Xawe, the Chief Commissioner at the International Trade Administration Commission, he's been looking at the issue around steel, and it is so devilishly difficult. But I think it's a very important issue. And then, of course, we will also be speaking to Warren Ingram this evening. What to do if the stock market crashes next year? Diversify, Warren. Why would you do anything else?
WhatsApp Stephen
on 072
702
1702.
I should have known that somehow a conversation about vegetables would run me into trouble.
Evening, Stephen. Can you please stop referring to Botswana as Botswana? Botswana is the name of the country. The citizens of the country Botswana are Botswana. Can you please refer to Botswana as Botswana and not as Botswana? In the same way you'd say France and not call France French.
Oh, sorry about that. I did mean Botswana, the country, in the way that I was referring to it, and I am aware of the difference. I think I just wasn't as clear as I should have been. Sorry. But yes, I did know that the conversation around vegetables would get me into trouble in a little while. All right. I just still think that the actions of the government of Botswana need some further evaluation. Let me put it like that. 8 minutes after 7.
702. Stephen is on X
at Stephen Grootes.
Right, 8 minutes after 7. Well, there have been so many issues with our major steel producer, ArcelorMittal, has had to shut down its long steel business, mainly because there's an oversupply of steel on global markets. The Chief Commissioner at the International Trade Administration Commission, Ayabonga Xawe, writing in his personal capacity today, or this week rather, that around the world, we are seeing governments having to get a lot more involved in the steel industry. Well, the Chief Commissioner is on the line now. Ayabonga, good evening, and thanks for your time. You've written, I thought, quite a robust argument essentially saying governments have no choice but to get involved in the industry. What are you saying here?
Well, good evening to you, Stephen, and good evening to your listeners. Well, I think, there are peculiar features of the technological profile of making steel across the world that have created all manner of market failures, that have necessitated state intervention. And I think really the piece was to locate our own debate and our own national steel crisis in a global context. This on the back, Stephen, as some of your listeners might be aware, of a decision by the lower houses of parliament in France to effectively push a motion to nationalize ArcelorMittal France. And of course, it still has to go through the process there. But we also did see earlier on in the year the introduction of the British Steel Act, which effectively, for all intents and purposes, placed under state control the Scunthorpe Steelworks, which is a critical feature of the industrial backbone of the United Kingdom. And I could give you many other examples. The United States and their interventions in U.S. Steel, the conditions to the merger between U.S. Steel and Nippon, and then add to that, of course, the intervention that one sees in the steel sector in China. And add to that further the type of intervention to secure feedstock in India that we saw in the budget speech earlier on in the year, and similarly measures by the 27 nations in the EU to try and deal with scrap exports as a critical feedstock into making steel. So if there's anything in the last over 45 weeks or so that we've had in 2025, you've seen all manner of examples of state intervention in the steel sector, indicating the extent of the crisis that we see there.
So, I mean, the price mechanism is broken. I don't think anyone can argue with that.
Yeah.
So if that's the case, is it true to say there are no good options? There are only bad options and expensive options for governments?
Well, I don't know. I mean, I don't know what is good and what is bad. I think the necessity of steel in almost everything that we have, whether in our cars, in our homes, in our washing machines, in our sinks and so on, makes reliance on importation of steel a massive resilience risk for any nation. And so if the price mechanism is broken precisely because you've got a chronic rather than episodic overproduction in that market, then it does necessitate not only nation-state level intervention, but increasingly we're starting to see that intervention taking the form of interventions by economic communities. I mean, take, for instance, what the European Union announced a few weeks ago, where they are effectively walking away from the bounded tariffs they had on steel that they'd agreed to over 30 years ago. And they are saying, well, conditions have changed. And as a result, we can't really continue to trade in the manner that we did before. And we are triggering an Article 28 process in the WTO. So I think every country that has had a steel or foundry industry is finding itself with what might be seen as probably the least best option to retain whatever capability they would have had.
At some point, you have to have a conversation around whether you need to retain the capacity, the capability. Do we still need to be able to make to make this kind of steel in South Africa? We're not there yet, but at some point, someone's going to have that conversation.
Well, I think it depends, Stephen. I mean, I think you have to decide in the very diverse product range of steel and the downstream uses of steel, which are the elements that you would preferentially want to retain some capability in, and which are the other areas where you're willing to say maybe some of your trading partners might be able to assist you so that you don't have an entire glut as a perennial problem. But there are certain areas, I mean, take the defense sector, just as an argument. The armored grades of steel that you see in tankers and even cash and transit vehicles is the kind of strategic steel resource that ideally you would not want to have a reliance on someone you have antagonistic relations with. Because what happens when those relations come to a head? Someone will starve you of the necessary steel that you need. And I could extend that to the steel grades that are used for armaments or even the steel grades that might be used for industrial and even household application. You do want to retain a certain capability. I mean, if you want to build a dam, think of how much steel you would need. And I think it presents a foreign exchange and balance of payments challenge if you're going to import all of your requirements. I mean, take the Lesotho Highlands water project, which is being refurbished and maintained at the moment. Massive amounts of steel. Take our transmission expenditure, that capital expenditure by Eskom on transmission lines. massive requirements for steel, you probably don't want a situation where you have an over-reliance on external sources for that kind of steel.
Steel prices are low because there is so much steel in the market. And
much more than anyone can absorb, yes.
Yes. And isn't that, there are many reasons, there are many people who produce it. But the single biggest actor, I mean, would it be China? And would it be the Chinese government that at a stroke could affect this one way or another?
Well, I think, yes, China is a big part of it. But I think often when we say it's only China, we overlook the massive capacity buildup there's been since the global financial crisis in India, for instance. We overlook how Turkey, without any iron ore, has effectively become a dominant steel producer in the EU, and effectively in products like coil, wire, and many of the things that are often seen or unseen. They've dominated certain product markets in the European Union on the back of building a massive electric arc furnace network that allows them, even without an iron ore presence, like, say, Australia or South Africa, to still be a dominant kind of steel producer in the Northern Hemisphere. So yes, China's a big part of it, but I think to only say it is China is to overlook the massive capacity ramp-up we've seen in the last while coming through from Turkey and India. But for us, Stephen, I must tell you, part of the other capacity ramp-up we are beginning to observe is actually in our neighborhood. Look at for instance, billet imports we're beginning to start to see coming through from Zimbabwe, where you've got a steel mill that's been set up there on the back of Chinese investment that is beginning to bring product into South Africa already. And so the market is changing in ways that, one, are unprecedented, but I think second to that do necessitate different forms of state intervention. It's not just about intervention for intervention's sake, but it's about intervention to not just retain capability, but to also make sure that you don't have a situation where unmanaged expansions of capacity end up kind of making the entire balance out of kilter.
I mean, if ever there was an argument for a sort of internationally coordinated response, this would be it. But that's, I mean, I
don't know.
It just raises so many issues.
Historic in the 20s, there used to be something called the International Steel Cartel. And those who are a bit older than I am often say that, after the First World War, that type of international solution, at least among those countries who are part of the kind of Commonwealth or the Imperial Conference, effectively came to a head and was one of the trigger points for what we saw in the Second World War. So I think often when you begin to create cartels of a transnational character, they then also begin to portend all manner of rumors of war.
Ayabonga, thank you. Really do appreciate it.
Always a pleasure. Take care, man.
I should really call you the Chief Commissioner of the International Trade Administration. Ayabonga Kawe, 17 minutes after 7.
The Money Show, Africa Business Focus.
19 minutes after 7 the time. Well, Dr. Rutendo Ndingwi, the founding director at Tribe Africa Advisory, author of the book Rumble in the Jungle Reloaded, with us. Rutendo, how's it? Good evening. Good to see you, man.
Always good to see you,
I know
Stephen.
It's the last time this year. We haven't broken the news to Aubrey yet, but we will.
We will slowly but surely.
We've been talking a lot about trade. You heard Ayabonga Kawe from the International Trade Administration Commission. And we were talking earlier as well about how new car inflation in South Africa is at 1.6% because of the new cars, the cheaper cars that are coming in. They're made in China primarily.
Imports,
and Chinese exports to African countries up to $200 billion this year.
Yeah, $200 billion. Last year, Stephen, as at end of December, it was $297 billion. So by end of this year, it will definitely probably reach that and peak that. Bearing in mind that globally, the Chinese surplus on trade is $1 trillion. And collectively, Africa has got a deficit of $60 billion. So the upside, obviously, from a Chinese perspective, even with the global tariffs and the war with the US, the business is doing well for them. They're still exporting. They're still importing into Africa a lot of their stuff. And another key dynamic, Stephen, is that they've just had the announcement of the launch, I think it's in December, of their Nin port, which is an island in China. And that is a free track zone. So what they're going to be doing there is that they've reduced tariffs for 74% of line items to zero tariffs. And also, I think corporate tax is going to be about 15%. So they've really created incentives for people to export to China, and obviously Africa is a key target market. So from a Chinese perspective, we've known they've always been a big player in Africa. I think the challenge is for Africa to say, how can we position ourselves to go up higher the value chain, and that's always been the case.
It also shows you, how the world is changing. Isn't the United States losing its economic influence on Africa, and that's because of their own choices?
It's because of their own choices, and I think what this shows, was if you see the growth in China in terms of whether it's exporting to Africa, the key regions that are driving that growth of trade for China, Stephen, are trade with Africa and EU. And some of the Asian markets. So although there's been a lot of instability from a world trade perspective, China doesn't seem to be taking a negative knock. Although analysts still predict that it's unsustainable, this rapid growth that's happening from a trade perspective eventually will flatline. But at the moment, they're smiling all the way to the Chinese bank. Sorry to use the pun.
No. So it would seem. Ethiopia, they've looked at a big sort of deal. It's $29 trillion on the gas by rail agreement. That's huge.
So the reason it's Ethiopia is the agreement has been signed in Ethiopia. It's with Ethiopia and the Inside Dynamic Resources. It's a big consulting firm. The actual project, Stephen, is given this unique name. It's called the Iron River of Energy.
Wow.
And the ambition, Stephen, and $29 trillion US, a lot of money, is to build a gas by rail network that's about 73,500 kilometers long. So just to give you, in terms of the length of this, from Cape to the furthest point in North Africa, which is Tunisia, it's about 8,000 to 10,000 kilometers. So 74,000 Ks of gas by rail is a big thing. It's been driven. The key partnerships that have come together in order to deliver on this is obviously it's based on clean fuel, clean steel in terms of the construction of the pipeline. The idea is to reduce carbon footprint by 75% by using clean energy. And two key partners that have come together with the African players are Germany SMS Group and the US Wastech Corp. So it's a positive initiative. It's a very ambitious project. A lot of money is going to be spent, but they're putting pen to paper, and I think it's going to cover 40 sub-Saharan African countries, and Ethiopia, which is usually a birthplace of most big African ideas like the OAU, is going to be signatory for this project.
But it's going to have an impact everywhere.
No, it will, because, where does this sort of fall under? If you think about the African Continental Free Trade Agreement, free movement of goods and people, this is spot on in terms of that. One of the big challenges we have in Africa, Stephen, is you know very well that there are about 600 million people who don't have access to electricity or power. And we've seen a lot of initiatives around this. So this is an element of bringing energy. I think the estimated number of people who benefit just from a beneficiation perspective is 1.2 billion. But then think from a value chain perspective, from an ecosystem, jobs created. And it's not a Chinese play, the way I understand it. It's actually quite a pan-African multinational play. So it's a humongous project.
Yeah.
There's such an English word, but ultimately, I think it will bring the right impact in what Africa needs from an infrastructure perspective.
Sure. The United States has signed a new deal with Rwanda. Very interesting to see those two countries sort of teaming up. This is actually about health.
It's about health, and this is on the bank. Obviously, we know that President Kagame and President Tshisekedi were in the U.S. They signed a peace deal, although I heard rumors today that the guys are no longer trusting each other. But coming back to reality, the U.S. has invested about $228 million US, and this is specifically into the health space. They've got an initiative called America First Global Health Strategy. I can see you smiling, Stephen, on the name. But I think the key thing about this, Stephen, that if it does work out, which is a good idea, they've moved away as America from investing in pure aid. And the idea is that it's a strategic partnership, so they'll co-invest with Rwanda. Why is Rwanda quite key? The reason is Rwanda, you remember, from an AFCFTA perspective, from an African perspective, they've become the sort of the innovative biotech hub with regards to developing vaccines, developing pharmaceutical solutions on the continent. So if this $228 million US, and it's supposed to be spread out over 5 years, has got the vision and the deliverables that it's committed to, and if it's a sustainable model in terms of helping cure HIV, AIDS, malaria, TB, and polio, then it's definitely a step in the right direction in terms of the bigger picture for Africa and obviously East Africa and Rwanda.
Obviously, we need peace in that region, though, and I know that Trump likes to kind of almost enforce a peace. But I don't know nearly as much as about the conflict between the DRC and the M28 and all the rest, M23 and Rwanda. Except to say that's been going on for so long. You can't just impose a peace. It's a bad peace is no peace at all.
And that has been the complexity of the peace in Africa, is that that war has been so long, and at the core of it obviously is the issue of the precious minerals that are there and the dynamics around that. So I think it's easier said than done. But we just pray and hope that that peace will be found and a solution will be found. But ultimately, you don't throw out the baby with the bathwater. If this $228 million lands in that pharmaceutical innovative hub in Rwanda and makes the positive impact, so be it.
And then Ibrahim Mahama from Ghana, the first African to top the annual art power list.
Big achievement, Stephen. And this is an art award that is analyzed by 30 anonymous experts from around the world and judges, and it's been running for 24 years. The first time an African has won it, Ibrahim Mahama from Ghana, and he uses a very unique style of art. He uses old hospital beds and discarded train carriers. And also one of the key things that he also does, Stephen, is that he actually used a drapery art piece which had to be designed or built or sewn on a football stadium. That's how big the material was. So he's number one, and quite an achievement. And he was educated at Kwame Nkrumah University, obviously quite significant from a historical perspective. And I think it's a great African story that we've got great talent. I've been to Ghana a number of times in Accra. There's an art market that is there that's always fabulous and can never live with it. So for him and Ghana and Africa, it's a big thumbs up.
In art, size mattered. I didn't know.
Now you do, Stephen. Now you do. And it's good to see Aubrey in his hat and smile back in the room. Welcome, Aubrey. Well, feel at home, please, at 7:02.
Appreciate it. Yeah, absolutely.
This is his studio in half an hour. 22 minutes. 32 minutes.
It's a very important subject, especially when it comes to size.
When it comes to science.
Okay, gentlemen, that'll do. Rotendo Wandingwi, Dr. Wandingwi is the founding director of Tribe Africa Advisory. 28 minutes after 7.
The Money Show.
Personal Finance with Warren Ingram.
24 minutes now to 8 of the time. Well, one of the great sort of fears that seems to be emerging more and more, one of the great conversations is there a bubble in international stock markets, and particularly in the US? And Warren Ingram, the certified financial planner at Galileo Capital, has decided, cheerfully, Warren, I noticed that this is what we should talk about tonight. What to expect if the stock market crashes. You know, as always, your questions for Warren, 011 883 0702 021 446 0567, and we'll take your voice notes as well on 072 702 1702. Warren, good evening. We spent a lot of time trying to work out what's going to happen in the next year, and actually, as I suppose you remind us, we don't really know a thing.
It's such a game we play, I think, as an industry, but also as humanity. You know, when we wake up every morning, I don't know if you do it, I do it. I open my phone and I look at the weather app as if that's somehow reliable, and it's actually going to tell me what's really going to happen. And we do the same thing with our investments. We listen to very clever strategists and economists, and they give us very detailed reasons as to why the markets are going to go up or down, or whatever it is that they're forecasting for the month and the year ahead. And somehow we feel better that we've been given this very clever sounding forecast, and now we know what's going to happen. So we value the certainty, and then, like our weather app, we get severely disappointed when things don't work out as promised. And you're right. We're living in a time now, Stephen, where I'm so tired of talking about the bubbles, but that's what people want to hear. Is they want to understand: are we in a bubble? Is it going to burst? When is it going to burst? You know, what day exactly? Maybe down to the minute. And then kind of giving them the answer, which is for them deeply unsatisfying, where you say, "Gee, I don't know." You kind of leave them unsatisfied, and so I thought, how can we help people maybe get a parameter of certainty? In other words, if it crashes, and that's certainly not a forecast I'm making. I'm humble enough to say I don't have a clue what's going to happen tomorrow. Forget about 12 months' time. But if it's going to crash tomorrow, what does that look like, and what should we prepare ourselves for?
We talk about this as if it doesn't happen often, but do markets fall often? And I know at some point we need to remind ourselves that over the longer term, markets always grow.
Markets do always grow, and they have always grown despite many predictions of calamity and, the end of the world. Somehow markets survive and continue to thrive. And we also know one of the good adages is that when America sneezes, the rest of the world catches a cold. And that might not be as true for the dollar, for example, as it used to be, but it's certainly true for the American market. If the American market has a big crash, it will affect all other markets for a period of time. And so understanding what happens with big market crashes in America is key to understanding how we will be impacted. And in the US, the American market falls, and when I say falls, I mean if you measure it from the 1st of January to the end of December, it falls 1 out of every 4 years. So you take a typical 4 or 5 year period, and you would expect the market to have 1 year where it is negative. And so it's actually rather common. A quarter of the time, you lose money by being in the market over a year. What's interesting is how surprised people are, and whether it's people like you and me when we're talking about this stuff, or investors who just happen to have money in the markets, or professional investors always seem surprised after a market fall. And the truth is it happens quite frequently. What's maybe more helpful is to understand what does that look like when the market is down over a year. And typically it's going to be down about 13%. So if you started the 1st of January, let's say we're on the 1st of January 2026, we've got R1 million in the markets. But by the end of the year, we would expect that to be down an average of 13%. In other words, 31st of December, our R1 million is now worth 870,000 rand. So that's the typical movement of an average down year. And I think, that's the context we should be ready for, is if there is a correction or a crash or whatever you want to call it. I know people don't like using the word crash. We should talk about it. But that's what we would expect, is that it's typically around 13% a year.
The fall can be a lot bigger, can't it? I mean, you can have a fall that's a lot worse than that. I mean, particularly if you go back to the global financial crisis, I mean, wasn't it more than that? That was a big thing, though.
It was, and maybe, not a lot of people are talking about, the IT bubble in 1999 up to the year 2000, because that's somehow related to tech, and now, the fear is that we're in another version of that. And 2000 and the year 2000 and the 2008 crash, you were looking at a fall of about 40% over that 1 year period. So again, you start the year with R1 million and you end the year with just fractionally more than 600,000 by the end of December. So it is a big number. And what's frightening about that is not the fall, it's how badly people respond to that. Because what they do, and we do it en masse, we see it happen, but through thousands of investors, that they remain fairly logical, fairly rational for the first 5% of the fall, then the next 10, and then the next 15. But somewhere along the line, at, I don't know what the number is, 20, 25%, people really start to panic. And then they flood the market with their shares. They sell because they believe it will not recover. And of course, as you said, markets tend to go up over long periods of time. So they make a catastrophic mistake, but we do it en masse.
We need to talk about averages here, and averages are basically the key, I suppose, to investing, along with diversification. But over averages, I mean, we've had such a great year on the JSE this year, and you kind of want that to continue. But we should realize that it is higher than average. What do averages tell us over the longer term?
So I mean, I have to give you a real dad joke here, but if your head is in the fire and your feet is in an ice block, the middle of your body is on average fine, but the ends are in real trouble. And so we need to talk about averages because they hide a lot of noise and sometimes they hide some potential dangers. And so when you're investing in shares and we're talking about a 5-year or 10-year period, you would expect your investment to grow by somewhere around 10 to 12% a year. That's the normal. But as you said, I mean, this year has been a fantastic year on the JSE. So way more than that, probably double, if not, who knows what the last few weeks of the year delivers, but maybe triple that. And just a phenomenal time in the market. And so, we should be rightfully saying, that's wonderful. We also need to know that it can't continue. The market just doesn't give you 20 to 30% year after year after year. If it did, none of us would be working. We'd all be professional investors. So we should anchor ourselves around that 10 to 12%. And when the market gives you much more than that, we should be prepared to say, okay, we should look at this with a lot more concern, a lot more consideration for what might happen differently next year. The only guarantee that you have with markets is whatever happened over the last 12 months almost definitely won't repeat itself in exactly the same way over the next 12 months. So it's very unlikely that we get another, big year. We might get a flat year, we might get a down year. But what's not going to happen is we're not going to get a repetition of what happened. And maybe with these averages, when we're talking about 10 to 12% a year, when you measure this over 5 years, what actually happens if you had to look at it from 1 year to the next, more likely your returns are giving you 20% and then it's 28% and then it's down 15% and up 14% and then down 1%. And when you do the average, it looks fine. It looks like it's 10 or 12% a year. But it's been a heck of a roller coaster ride in that time.
I mean, what that really tells you is that actually to invest over the long term, you have to be able to handle the volatility in the short term. You have to expect volatility. You have to expect a loss of 15% at some point.
Exactly right. And if someone said to me, give me a firm forecast for next year, what are you expecting? I'm going to say that over a typical 1 year period, the market is down by an average of 13% and up by an average of 21%. So your range of returns that you should expect over 2026 is somewhere between positive 21 all the way down to minus 13. And somewhere in there, I would expect the market would give us the return. And yes, it could be higher and it could be a lot lower, but that's the typical range of the markets over a normal 1 year period. And we shouldn't panic and freak out if that's what we see next year, where the JSE is down 11% and we think, this has never happened before and it's the end of the world. It's just another year on the market.
Okay. Your questions for Warren Ingram, voice notes on 072-702-1702. What to do if the markets do crash next year? Warren, what happens if there is a big crash? And I really do mean something like the global financial crisis. I don't want to, think of 1929 because that I'm hoping was a once-off, was something very different. But a major downturn. I mean, what can you expect in that scenario?
Okay, so a very quick history lesson. The reason that we can all be fairly comfortable that 1929 doesn't happen again is because the banks at that time were really unregulated. And if you were doing nothing wrong and you'd been paying your mortgage every month, and the bank was in financial difficulty in 1928, for example, they could knock on your door and say, okay, Stephen, we know you've been paying your mortgage every month, but we would like you to now repay the remaining 7 million rand of your bond by next week, or we're taking your house. Now, that's what they could do. Nowadays, they're not allowed to do that. So there is a lot around the regulation of banks that will prevent that kind of really bad behavior. And so if we're in a big crash, let's say it's a 40% year. What you should understand is that the big dips, they last somewhere around 8 months at the shortest, to around 24 months as a normal kind of longer period. And the average is around 16 months. So just, a year and a quarter. And what that means is if you started the year with 1 million, you ended, December at 600,000, it could take another year for your 600,000 to get back to 1 million. And that would be normal. That would be the thing you should anticipate. And a 1 or 2 year period where the markets are down might feel like a lifetime if you're looking at your statements every single day, but actually over a 5 or a 10 year period, that's a very small period of time, and certainly is part of what's happened in the history. So again, reminding people, when we talk about expecting to get 10 to 12% per year over 5 or 10 years, that includes years where you're seeing your market portfolio go down 40%. It's normal. You should be okay with that.
So you have to just ride it out.
It sounds like such an easy thing to say. Just ride it out.
Yeah.
That guy on the radio has just told us all to ride it out. Yeah, be calm and carry on. This too shall pass. But it's exactly what we should do. And the truth is, we're not wired psychologically to deal with this. We want to take action. When something happens, our fight or flight, urges kick in, and so we want to do something to prevent more losses and actually take action to correct the problem and regain the money that we've lost. And one of the things to understand is you can't anticipate the crash, and there is certainly nothing you can do to anticipate the recovery. And recoveries happen very quickly. And so, we could be all, sort of doom and gloom and worrying about, the end of the world because the market's been going down for 12 months. And then all of a sudden we wake up one day and we go, hang on, for the last 2 months, it's actually been going up, and it's been going up very strongly. And there's been so much bad news in the world that we haven't paid attention to share prices. So the news and the markets are very different. And so I would say, if we're in this next year and we're sitting in October and everything's down, 40%, and you ask me what we're going to do, I would be saying to you, we just ride it out. If anything, let's not look at our statements so regularly, and let's focus on, positive things like the weather and the Springboks and whatever else that we can, because the market will do what it does. It will recover.
Indeed. We're talking to Warren Ingram tonight. There's a question, Warren, for you from Emily. She says, hi, I'm supposed to host my family for a Christmas lunch this year. There are usually 12 people who come to the family Christmas. We rotate houses to spread the load. My problem is I actually don't have enough money to do a proper lunch for everyone. What should I do? That's from Emily. We'll have an answer for you, Emily, after this. 9 minutes now to 8.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
The Money Show.
Personal Finance with Warren Ingram.
7 minutes to 8, and Emily's question for Warren. I'm supposed to host 12 people who come to my house. We rotate houses, but I don't have enough money to do a proper lunch. It's a difficult one, Warren, especially when other people have hosted you in the past.
It's so typical of this time of year where people are financially pressurized and they feel shame or embarrassed because they can't buy the presents for their nieces and nephews, or potentially even their own children or their grandchildren, or in a situation like this where Emily needs to put on the spread and she just doesn't have the money, and unfortunately a lot of the time people resort to debt to deal with this. Instead of facing the problem head on, they load the credit card and set themselves up very badly for debt during a very expensive time of year. And so my suggestion, Emily, is to be clear, is to be kind. I would be speaking to the family. They are your family, and just being honest. I don't have the money. I know it's my turn, and I know I'm supposed to be able to do this, but I simply can't. And then find the solutions together. So sometimes it's a case of asking everybody to bring a bit a dish or whatever it is, whatever they can contribute to the meal. And I think often in this situation we worry about what everyone else is thinking, and I can tell you they're probably dreading next year because it's their turn and they don't have the money. And so being the first person to be clear about what's going on might take a whole lot of pressure off everybody. And frankly, catering for 12 people is a very expensive exercise. I'm not sure I want to be doing that on my time off. So maybe spread the load is the one suggestion, or secondly, tell everybody and see what they come up with.
Yeah.
And you never know what people value in a situation like this.
And just the honesty is always the thing. Okay, so let's just return to our main comment. We're worried about markets possibly crashing next year. Is there anything we can really do right now to sort of deal with our worry? And I don't know if I need to ask you as a psychologist or as an investor.
Both, because I think this is where we get to the art of investing rather than the science. The science tells us that we can measure the valuation of markets, and the valuation says that the tech sector in America is phenomenally expensive. There isn't a way to justify those valuations. And when you look at valuations in the rest of the world, they are much more compelling. So even the JSE, after a very good year, is still better value than the American tech sector. And if you go across the globe, that answer is true for all emerging markets and potentially some of the other developed markets. So the science tells us that we should allocate more money to the better value markets and reduce our allocation to the expensive markets. So very simply, you shouldn't be overexposed to the tech sector in America now. You should be more exposed to emerging markets. But the art of this is that the American market can carry on running next year. It can do very well. So don't sell out of everything, out of all of your tech shares. Reduce your allocation to tech and increase your allocation to other sectors. Make sure you're not overexposed to the stock market in general, and make sure you've got a good spread between South Africa and overseas, because we don't know what's going to happen next year. And it could be another great year for the JSE and maybe a terrible year for America, in which case you don't want to be all global and no local.
I suppose what it also means is you need to just think about what the scenarios are and who would be affected. And I mean, I suppose you talk about the valuations for tech shares. It certainly makes sense to me that the shares that are the most expensive will probably fall the quickest, because that's actually the share that really has grown so quickly over a short period of time.
Yeah. Unfortunately, what we do, though, it's human nature, is that we look at the thing that's done incredibly well and we almost form an emotional attachment to that. And we say, why on earth would I sell NVIDIA after it's done so well for me over the last 2 or 3 years? It's going to carry on doing that forever. And why on earth would I go and buy South African shares when they've been so terrible for the last decade? And if you'd made that decision at the start of last year, and it would have been a very bad call to avoid the JSE. So I think you need to be clear with yourself that when you've done very well, take profits. Don't be afraid to sell some of your exposure to the things that have done incredibly well for you. And if they continue to do well, that's fine, because you still have an allocation to them. But you should be reallocating to the cheaper parts of the world markets and enjoy that ride over the next 2 or 3 years. They might not deliver very well next year, but low valuations are a great protection against a market crash. If something's already cheap and it's a good business or it's a good index, it won't get a heck of a lot cheaper compared to something that's phenomenally expensive.
Warren Ingram, thank you very much indeed. Certified financial planner at Galileo Capital. Probably worth already just getting ready to share this podcast. I'm sure there are 1 or 2 jittery investors that and maybe just prepare them for what they might be a bit nervous of. Warren, thank you very much indeed.
The Money Show, Stephen Grootes, is brought to you by Absa CIB. Discover the latest trends shaping digital assets across Africa. Download the Absa Africa Digital Assets Insights 2025.
Well, in the US, things looking a little more positive than they were, all really about interest rate expectations. Finally, tomorrow, of course, we will know what the US Fed is going to do. Tomorrow evening, I should say. The Dow Jones at the moment down 0.18%. The Nasdaq up 0.18%, and the S&P 500 up 0.12%. Interesting comment, though, from the US President Donald Trump today, and Reuters reporting that he said basically that he would support anyone who would immediately cut interest rates. That would be a requirement, essentially. So someone who believes that they should immediately cut interest rates in the US would be a requirement for that person to lead the Federal Reserve. And essentially, that basically means he's looking for someone who will cut rates. And there's no sort of question of how difficult the economic argument is, but you throw the political sort of argument on top of this, and suddenly it does start to get very, very messy in the United States. The politics around the US Federal Reserve is getting very, very intense. I do think that is going to be one of the big issues leading us into next year, and how markets respond to that is probably going to be an even bigger issue. We'll be back tomorrow. Good evening. It's 8 o'clock.